All right, welcome back, YouTube. Let's start today's market analysis. So today the market was pretty interesting. We saw a big fall and a change of characteristic in the CNX small cap. I think this has started a red zone now. We don't know how long this red zone could last, but I think that's definitely the start of a red zone. The reason being, we can see a clear break of the 5 MA, right? Now, the small cap index was riding the 5 MA quite well. I'd say ever since Monday 12th May, we can see that the 5 MA has been respected throughout, except for this day, on the 22nd. But there's no follow through action, and then the 5 MA continues being respected. And now finally we've broken the 5 MA decisively and taken a support from the 10 day. Now the 10 day line is very crucial. I would expect the small cap index to wait here, but how it could also very easily just go down to the 21 day. Regardless, it doesn't matter because, as you guys know, I'm in complete cash. I have no holdings. The reason for this and the reason for such performance, being in cash right before the market is falling, is just a lot of experience, a lot of hard work. But another tool that has really helped me has been market breadth. So when I'm talking about market breadth, I'm not necessarily saying that it's important to look at MBI numbers. I'm saying that it's important to take a lot of feedback from the overall market. So what I want to really dive deep into is the fact that watchlist stocks were not working. So if we go back to our candlestick pattern, right? Wockhardt Pharma was one of the only potential good breakouts that happened yesterday, along with some other names in the pharma industry. But as we can see today, there's no follow through action. It still held its space. AstraZeneca was holding. It's a breakout for today. Bellrise, again, look at this. So this stock broke out here on this day, right? This is the breakout of this stock. Consolidates for a couple of days and makes a big outside day today. Now, this kind of action is very common when you have a tired market. Now, we can see that the market is very, very clearly tired now. We've seen a pretty big up run right from here till here. What is that? Around 21%. We've seen a 21% move in the small cap index, and now we finally, gotten that much needed pause. And this pause is very important. I would say that the more the market waits here, the better it is for us, because it'll be easier for us to also find the next stocks, the stocks that are gonna, really take on the rest of the rally. Because if there is another leg from here, it would probably be from here up to all-time high, and then we would consolidate again to absorb these supply levels. But the understanding is simple, that we want to have some consolidation here. What happens in a consolidation, right? It's important to understand that there are a couple good things from a consolidation. Firstly, you're not running too fast. It's a very simple analogy. The faster you run, the more you're going to get tired. So it's always better to run, take a break, right? So now that we've had this furious up leg, now we're taking a break. We've had another furious up leg, we'll take a break, and then we can see another furious up leg. The idea is to make sure that you're part of the market during these up legs and then stay out of the market during these down legs. And your stocks or your holdings are the best guide for you to get out or stay in. Now the reason why, for example, let's go through some of the trades that we took. Okay, so GRSC, right? Now understand the characteristic of a stock, and that will tell you itself whether it's time to stay or go. So GRSC has ridden its 5-day moving average throughout its move from its earning gap. And after that, we can see a very decisive break of the 5-day and a further break of the 10-day as well. So it's evident that there's a change in characteristic. Cochin Shipyard, right? Again, this stock, I would say, has ridden its 10-day more than its 5-day. However, again, we can see a very clear change in characteristic, and 5 days of fall is not good. They should have consolidated today or given its up move, but the market did not support that. Furthermore, Premier Explosives, I would not talk about this. It's too volatile. Look at this, Apollo Microsystems, right? So we see this run up, and then we are seeing a break of characteristic, and a break of characteristic is not good. What it should have done is consolidate here, right? Hold this position here. Hold these positions and then get ready for another up move. But that's not the case. So the market for now, I would say, is it's time for a pause. It's time to wait over here, consolidate, because you can see that there's a very clear V-shaped recovery that we're making here. I don't know if a V-shaped recovery is good for the market, bad for the market. The market is better to decide those things for itself. But there's definitely a V-shaped recovery. So the more pause that we see over here, the better it would be for the overall market. If you were to look at other indices, like Nifty, okay, so Nifty today has made a very decisive fall, and the 10-day and 20-day have come together. And now this is a very crucial point for Nifty. If Nifty breaks this level, right, breaks this 10-day level, then we can see more downside in Nifty, probably till the 50-day. But another good thing in Nifty is that we've entered a golden cross. So a golden cross is very good. The same is probably going to happen in the small cap index soon. It'll take some more time, maybe somewhere 1st or mid-July, or maybe if we continue an up run from here itself, maybe in the first week of July itself. But I think that a pause would be ideal for now. The idea is that the moment you get a pause, the strong sectors automatically will come out. They will tell you what it is. Is it going to be EMS stocks? Is it going to be solar stocks? Is it going to be pharma stocks, right? We don't know right now. But the moment we see a pause of 2-3 days more, we'll automatically understand what exactly it is to trade, what it is to make big positions, where to make big positions, etc. Another thing that I wanted to talk about is the fact that we could see that today, let's have a look at the stocks that actually worked today. So, okay, chemical, agriculture stock, utility stock, First Motors, pharma, another chemical stock, another pharma stock. So maybe somewhere we are getting an indication that pharma, chemicals are going to be probably a hot sector for the next whatever rally or the next up leg we get. But again, we don't know. So I would say that till the time, just chill, enjoy, study the market, get better, stay in cash. I'm in 100% cash. I have 0 holdings. The entire idea is to make sure that I'm out of these down legs, because the down legs are the periods that are very fierce, right? So like, let's say in this particular up leg, I made an impact of 10% on my portfolio, which I did. But this down leg itself can cost me minus 5% on my portfolio very, very easily. So now that does not make sense, right? Like, sure, you're still making money, but you're giving back 5% of your portfolio. And you do not want to do that, of your profit or portfolio, whatever you want to say. And that's the entire idea. Stay out of the red legs and stay in the green legs. And how do you mark a red leg or a green leg? It's very easy. It's just basic Dow theory. So when the market goes up, it will always go up, and then it will consolidate, and then it will make its next up move, and then it will consolidate, and then the same, right? But now when the market goes down, it's the same theory. You go down, you come up, and then you go down again. Whenever there's a change of characteristic is when we say that now there's a new trend established. So this can be done in a micro frame and a macro frame, both ways. So if we look at a micro frame, here we can see a clear down run, a bit of an up run, a down run, a bit of an up run, a down run, a bit of an up run, right? However, this is now a change of characteristic. Why? So this is one low, we're going up. Now this is the next low. Okay, so this low is greater than this low. Now we're going up. We're coming down and we're going up again. But this low is not greater than this low. So suddenly there's a change of characteristic. And now this high is greater than this high. So we've gone from a downtrend to an uptrend, potential uptrend. And that's exactly what happened. We were in a downtrend and we moved into a potential uptrend. So similarly, now over here, right? Let's say we consolidate here. We go up, but we're not able to break these levels of 19,000. Without breaking these levels, if we fall down again and break the low that the base makes, we can assume that we're in another downtrend. And that is not good. So exactly, the next few days are going to be very decisive for the market. They're going to tell us whether we have to invest more, whether we have to stay out in cash. Regardless, the market is always supreme, and always let the market make the decision for you. Now, another thing that I wanted to sort of highlight were the breadth numbers. So what I did understand is that I understood very quickly over here in this phase, in the 50-day breadth, that we are peaking now and it's time for a pause. The reason being, we've reached resistance levels, right? It's very clear that the breadth has reached resistance level. And just because we are at resistance level does not mean stocks don't work. GRSC, R Power have all worked in these resistance levels. But for how long is the question? You can't stay at these levels for an elongated period of time, right? Eventually, you have to come down, test some levels again, and then maybe make a move back up. And that's exactly what is happening. The same with the 20-day breadth. We're seeing a very clear fall, and it's good. I would say come fall more, fall to the 50-day line, and then show another up run, and then fall again and show another up run. And that's just how the markets are going to be anyway. But that's the entire idea, that I want the market to now pause. If we talk about setups, I don't really see any setups. Amber is a good setup, but again, for me, it's very simple. This is how I look at the markets, right? Let me just tell you. The number one priority for me in the market, okay, one is market environment. Okay, the number two priority is sectoral strength, and the number three priority is setup. It's very, very, very simple for me. If the market environment is in a clear downtrend, I will never trade. If the market environment is in an uptrend, but there is not a lot of sectoral strength and setups are working here and there, I might take small positions, but I cannot even think of taking a 20-25% position. But if I'm getting good market environment, good breadth numbers, good sectoral strength like defense or like power, and a good setup like R Power, I will go all out, right? And that's why I took a 25% position in R Power. And that's the entire way of thinking. GRSC as well for me. This last leg of GRSC, this small leg that we see, this was a 25% position as well. Cochin Shipyard, actually, Cochin Ship, over here I had taken a big position. I think it was a 20 or 25% position here, but it did not work. Why? Because if I take you to a replay, we were still not ready. The 50-day was not above the 200-day, and that is one of my main observations. That just have a look at Cochin Shipyard, right? Breaks out, fails. And now we are converging here. We're making a good convergence. Okay, you pause, and then you break out the moment the 50-day catches up, you're breaking out. So you're up 5% this day, you're up 2% this next day, and then suddenly you're up 13%. So you get a big breakout of 16 odd percent over here. Now, the only reason I was not comfortable sizing 20-25% here is because, again, the pivot was not somewhere around the 3000 levels. The moment the pivot comes to the 3000 levels, I'm really interested in sizing big. But small over here, I would be 15% position size, maybe. Nowhere close to 25% at least for me. Another question I was getting asked is railways. Why are you not interested in railways? And for that, I wanted to let's discuss a few railway setups. Railways. Okay, here we go. All right. Now, why exactly I'm not interested in railways? From its highs, this has been down 61%. And currently, from its highs, even if I give it benefit of doubt, we're down 36%. Point number one, 2 beaten down. All right. Point number 2, we're not in a golden cross. In fact, where I was being told or asked, or like over here at these levels, we are still below the 200-day. The number one rule of Mark Minervini, or number one rule of any great trader, is to not even touch a stock below its 200-day. So for me, railways were never in question, right? Yes, 100% they've been a winning sector in the past bull run, and they've really rewarded us massively. So if we have a look at RVNL, it's been an insane bull run in RVNL, right? I would say like what, probably I think 1700% or something. Yeah, 1400% there. So you've made a lot of money in RVNL. Let the stock come back to its 600 levels. I'll be the first one to enter the stock, but not right now, because the moment you're below your 200-day moving average, for me, I'm not in that stock. Especially if that stock is below its 200-day moving average and it's trading below its 200-day moving average. Like even if you're trading at 550 levels and your 50-day has not caught up to the 200-day, okay, that's still, I can maybe give it a shot of 10% if there's super sectoral strength. But you're trading below the 200-day moving average, I can't even think of buying you. And that was the entire thought process. Even Jupiter Wagons, it is the same for each and every railway stock. Now RailTel is giving me good signs, right? What I want from RailTel is whenever you want to move, come up to this level, right? Pause for some time here. I'll buy you a smaller size. Come back up here, right? Pause again. by this entire period, this 50-day line is going to be above the 200-day line easily. And when that happens, then I size big. So it's all about a game of probability, making sure that you're in the right stock at the right time, right? You can find a VCP anywhere. You can find a VCP on the 1-minute chart, on the 10-minute chart, on a 75-minute chart. The idea is, where is that VCP being formed, or where is that flag being formed? Is it being formed in the lower third of the base, or is it being formed in the upper third of the base? And that's the entire reason. So summing it all up, I think it's time to stay out of the market for some time. It's more important to take a break right now. Really reflect on how these past 2 weeks have gone for you. Has the market been rewarding? If so, what did you do right, and how can you do that better? Has the market not been rewarding? If so, what did you do wrong, and what can you do better? It's simple. Game of life is a game of compounding, and the game of life is always a game of getting better 1% every day. So if you can ensure that you're getting better day by day, that's all you want. Just the way Virat Kohli does it, right? It's the same thought process. So that's it for today. I'll meet you tomorrow, and let me know if you like this video. Please do like, comment, subscribe, and just help the channel a little. It's been quite a few good weeks recently, and now it's time to really step up and really change the game. Thank you.